The Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
1490 WGCH. This is Carrie Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote.
Hello, everybody. Welcome to another edition of the Value Guys Stock Talk Show with the Value Guys. I'm Val Hughes.
And I'm Momentum.
And we are 31.4-year Wall Street veterans who have had to take on secret identities and go underground in order to provide you with a couple of value stock ideas each week that we run here in the shop. You've seen our faces on TV. You've seen us quoted in the news, but our bosses would never allow our unfiltered views on the air, so we've disguised our voices, and they'll never know. This week, it's May 29th. We've run a screen based on enterprise value to sales, an old tool in the Value Guys toolkit. But before we get to that, a couple of important caveats. First, this show is for entertainment purposes only. That's not a guarantee. Secondly, this is a hobby for Mo and I. We're just after work, kicked back, having a few after-work beverages. But we are, analysts during the week, doing a lot of careful research and meeting with management teams and doing forecasted earnings projections, etc. And, of course, we're doing none of that here. Third, and our lawyers say to remind you that we may not have your best interests in mind and may accidentally recommend the opposite of what's best for you, so do your own work. And then fourth, we've been just modestly drinking this week.
More than modestly.
Yeah, I hope to improve that during the show. I think that's it. See all our caveats at www.thevalueguys.com, where you'll see links to past shows. We got about 5 years of shows out there. A best ideas list that I keep pretty current, and also we've got some interesting statistic links there. It's a menagerie of links.
A menagerie?
Yeah.
That's
I don't want to get too much into
financial
that.
term.
www.thevalueguys.com. Okay, this week, a big historic first at the Value Guys. Do you know what it is, Mo?
Yes, we're being broadcast via satellite to the Soviet Union.
Yeah, there's been a breakthrough in communication there.
But
something else as well.
Welcome,
something else.
New listeners.
Comrades. But there's something else as well.
What's that?
This is the first time in the history of the show where the date has not been a Friday. Okay? Now, a lot of people aren't going to think that's a big deal.
Could throw you for a
including
loop.
most of the people, right. But if you think it's Friday because you're listening to this, it isn't. We're putting up a show. It's actually Tuesday, and we're just putting up the date. I mean, for years, if we did it on a different day, we kind of moved the day to Friday.
And we get to have cocktails in the summer sort of whenever we want.
So we're just, right. There's no schedule for that.
Exactly. So why not do a show?
So it's actually May 29th, Tuesday, May 29th. And we've run an enterprise value for your value investors out there. We're just running an enterprise value to sales screen. Companies below $2 billion, any public company. We just ran this on Yahoo Finance. So if anyone can do it, it's free. We put in a balance sheet filter, debt to equity less than, I did 1.2. So it wasn't quite 1 because we weren't getting enough names. And then I think I threw in a little profitability filter. So I need profits. I think I need an ROA greater than 5, return on assets. And we pulled up about 40 names.
Yep.
And we sat here very clear-headed initially and went through those 40, and we've picked out 3 that...
Actual good ones.
Well, I'd say 2 of the 3 are good.
And one's pretty controversial, but it's just...
One's not as good.
You're either going to lose all your money or you're going to triple your money.
I don't know. Maybe listeners could figure out which one that is. I'm not sure.
Yeah, that's going to be an interesting one.
And then, so we're going to have three, pretty good value ideas. Actually, two, and then one that's not as good, but it's controversial. And then we're going to have a segment of the show walking through national economic trends that people seem to like. So we've just pulled the, National Economic Trends publication from the Federal Reserve Bank of St. Louis. It's free, and it's got everything you might want to know about the U.S. economy and a lot you don't want to know.
And three-dimensional pictures in some cases.
There's all kinds of great stuff. So we're going to do that at the back end of the show. But first up, what? We got some news, right?
Well, today's May. It's going to go down in history as May 29.
Yeah, right.
And today, Facebook hit $29 a share.
Yeah, I saw that. Yeah.
Yep.
Yeah.
So, they say that behind every cloud is a silver lining.
Did you?
I'm not going to renounce my citizenship.
You're not. You're going to stay
I
in
don't
America?
need to, really. I had, when I thought the stock was going to 1,000, you look at contingencies. So if you really do, you renounce your U.S. citizenship.
A lot of
you
fine
just
countries.
Declare yourself a, resident of the Philippines.
Or Dominican. That's still a plane ride.
So, but I'm not going to do that now.
You don't have to.
Well, I prepared for a lot, but not $29 a share.
Yeah. Well, this way, if you stay American, you get the full tax rate on the loss.
That is true. Yep, that's true. But I still was the first guy actually the first hedge fund manager ever to make money on Facebook, and now I'm the only one.
Were you sure?
No.
No, you were the only manager who did not short it.
No, I'm the only.
Money.
Yep,
no.
Exactly.
Okay. What's your secret, Mo?
The secret is that I sold 2 passes to the IPO for $100 each, and so I was the first guy ever to make money on Facebook.
You sold your
exactly,
your
and now I have a 0% investment. I've got a $200 return. I'm adding those return figures to my fund.
Are you hiring anyone?
So it looks like I'm up about 100,000%.
Because you started a new fund that day.
So yeah, so it's been interesting. So thank you, Facebook.
That's been fabulous.
Thank you,
That's amazing.
So yeah, the new Wall Street technical term?
I'm sure I don't. No.
Well, they're talking about this in Greece and in Spain. It's not a bank run. It's a bank jog.
A bank jog.
A bank jog.
Uh-huh.
The outflows are just sort of like they're kind of running a 10K,
and
but they're not sprinters yet.
And there's water every hour.
Yeah. But the thing is, joggers can become runners
if they keep doing it eventually.
So
anyway,
so there's the word for the week.
But Mo, okay, first of all, back on this Facebook thing, I think there's a lot of interest in this. I don't want to mention any names, but didn't your firm, and I know we don't say where we're from, top secret and all that, but didn't your firm have something to, don't you have an announcement? Didn't your firm have something to do with all this, or what's...
No,
I mean, because it was priced at 38, right?
Yeah.
The investment bankers, the guys who come in our office, they're the best dressed. If you see a Wall Street guy, if he's the best dressed, that's probably an investment banker. You've got the white collars, the cufflinks. I mean, I'm down here we're in the dirty part. We actually have to buy a stock. If it goes down, we get yelled at. Our walls are... They're walls. They're not rosewood walls. You know what I mean?
Right.
You've been there. So these guys, they priced it. And again, we don't know who they might be, but maybe you do. They price it, and it was at 38 on that day.
And they increased the size of the deal by 25%.
And everyone is out telling all their clients to buy it. But now it's at 29. Where's my HP 12C over here? I still use this. So here, I'm just going to do this.
Do you know what I can tell you what the difference is just using it. It's called ouch.
Ouch, yeah. No, here we go. Minus 23.7%. So what if you were a guy who had priced it, or if you knew a guy, or let's say, I don't know, rode a train with a guy, what have you. Could be any number of things. What would that guy be saying right now?
If I were the investment banker that priced this deal...
Yes.
I would be saying, I would be calling the waitress on my private jet to have her bring me another martini because I'd be, jetting off somewhere kind of cool. I just made a shitload of money.
Yeah.
So that's That's what I would be
And
doing.
also, I will point out.
What would you be doing if you were the guy that had priced
if I were that
this
guy,
thing?
I would be explaining to the company how I just got them $38 a share, and right now it's at $29, so they should be pretty pleased
I'm sure
that they got a good deal. That's what I'd be
they'd
saying.
be thrilled, and you just
Yeah.
got about a $100 million bonus.
If you sold your home and then a few weeks later it was worth less, you're not mad. So in other words, Facebook isn't mad.
Right.
They're happy.
Right.
But the investors are not as happy.
Yeah. Oh well.
But they got in on a historic deal. I just thought so. So that's a Wall Street news item for this week.
It is.
So, all right. Well.
Alphabetical.
Yeah.
huh?
Let's. We don't have any theme music, but let's just get to the stocks.
If we do these alphabetically, our most controversial name is first. Do you want to save that till last?
Yeah.
Okay, let's do that.
Yeah. Why don't we? Because maybe we won't want to do it by that time. I don't know.
So we have JNJ
Okay.
Snack Foods.
JNJ Snack Foods. Well, let me do this one. I found this. This came on a screen, enterprise value to sales, so it's cheap. The PE here is 19, which is why it wouldn't come up on a PE screen. I'd probably go lower than that. But their net margin could conceivably get a little better, so that's one thing I like about an enterprise value to sales screen. You catch stocks that could be cheap if the margin is improving and you have a chance to go look at it before it shows up on everybody's low PE screen. So that's a nice advantage. The debt is terrific. It's very low. They do snack foods. So, again, there's probably a pretty good correlation to snack foods and population growth. There, of course, is some negative press on snack foods now. And, I think we need to talk about that. But by and large, the snack food companies are trying to stay ahead of the curve on health, and these guys are doing a variety of things. Soft pretzels, frozen juice treats. I mean, what could be more different than that?
Slush puppies.
Slush puppies.
Everybody knows what a slush puppy is.
They do baked goods.
Yeah.
People love that.
Right.
So I think, and they put their name on a lot of different things, and then they have brand names that, Fruit a Freeze, Icy you've heard of, Super Pretzel, admit I haven't heard that. So, they've got sort of the second tier brands of snack foods, and I think that's a pretty stable business.
Actually a growing business.
It's a growing business. Returns on assets are just now creeping into the double digits, 10, 11%. That's pretty impressive for what seems to be a commodity. So they probably have an edge in distribution. Their brands are, good store brands. There's something going on here that's good because they're turning out a good return on assets. EBIT margins in the mid-teens, or EBITDA, I should say. And so I like that. And the valuation, it's 9 times EBITDA. So to the extent that 20 times earnings doesn't sound good, 9 times EBITDA, if you do the inverse, is an 11% cash-on-cash return. That's pretty attractive, and it's growing. And all I'd want to go and do and see how much CapEx is required against that EBITDA to really keep the business, stable and maybe growing a little bit. Although at 11%, I don't need a lot of growth. So that's kind of what I like about it, Mo. It's just a snack food guy. It's reasonably priced, good balance sheet. They do have to navigate the health, thing a bit.
Yeah, well, I tell you what, the great thing about a company like this, because we look at these all the time from a technical standpoint, is you can use a highly sophisticated technical analysis to look at the company. What we do, and started doing this back in 2008, you know that as my fund, is we create a American Waste Size Index.
Yeah, the WSI.
Yeah.
Everyone knows that.
And as waistlines expand,
snack food companies
stock go up. These guys create dough-enrobed handheld products. That's not a sexual device. Dough-enrobed.
Right.
Dough-enrobed.
It's like a hot dog on a bun encased in dough.
Handheld dough-enrobed.
Right, dough-enrobed. It's a new term in food. It's in the 10K, ladies and gentlemen.
So anyway, based on our waistline forecast, that's a WWF, which most people know also.
We were talking about this a couple of weeks ago.
Exactly.
One of the other stocks we looked at was a Krispy Kreme.
You know, with a
By the way, that
waistline.
was a nice pick on your part. I think they had a strong quarter. It was up a lot. But
Yeah.
the same trend. It's like, yeah, we all want to lose weight, but are we going to? No. We've got a 2-million-year-old brain that craves this stuff.
Yeah.
And unless they make it illegal,
Yeah.
people want it, right?
Yep, that's very true. We've given increased weight to this idea.
I'm going to scale into this.
Well, wait no longer, because this is now something I think we should take a look at. But anyway, listen to these sales numbers. If I just round out,
please,
6 million in 2008, 6 million, 6.5 million, 7 million, 7.5 million, 8 million. That's that's like a little locomotive that just keeps cranking
Well, 100
along.
million, you mean?
Exactly.
Yeah, right.
But very little variation in that. So it's got a great sale, and despite that, in addition to that, just clicking along, margins have been, basically they've been 15%. Very little.
And they cruise right through the recession.
So,
there's no trouble.
Exactly.
I mean, if you're depressed, maybe eat more snack foods.
Well,
right?
So if you believe in the continuing expansion of the American waistline, you can do a direct correlation, pull the stock price up, go to the CDC, look at their expanding waistline. They publish our index. Compare the two, do an overlay. This is going to be a $100 stock in 5 years.
Well, I'd like to just add something because this health issue. I think that this company probably has an edge that's not related to the food quality. I'm just going to say it's distribution, and it's a second-tier brand that helps the store owner make more money because there's not as many demands putting sales, advertising back into the business and all that. It's kind of a sub-tier brand. There's not a lot of advertising, so there's a lot of extra money left over to share with the store guy. And I know that one of the things they sell is convenient food. So it's not healthy food right now. There's a lot of salt and things like that. And I don't know if you saw this, Mo, but Campbell's Soup made a big deal about taking salt out of their product. It was in the newspaper. It's like Campbell's Soup, and they quietly undid that when they took the salt out, and then guess what? Nobody was buying their soup
because it tastes bad.
Tastes
like water.
I'm going to say these guys are going to deliver what people buy. If the government or your health care plan that won't give you one if you eat too much of this, there's a lot of ways this could force diets in a more healthy way. If that happens, I believe companies like this will stay on it. They will make something that fits in your hand, that fits on the shelf, that takes 2 minutes to eat, that is decreed as good for you, whether it's healthy or not healthy. That's why I think the stock is a little cheap because of the health fear. But these factories can turn out whatever it is people want to eat. And they're doing that right now. If it becomes a problem legally or from a health insurance cost point of view, which are all possible, I think these guys adapt. That's why I think it's an interesting.
Plus, to get a yield, you get a little yield.
Yeah. What's the yield? Oh, I don't even 1%. Only 3 analysts too, so that's another plus on something like that. Okay. Let's see. Do you need a refill over there, Mo? How are you doing?
I'm good.
Okay.
Whoa.
Let's see.
Thank you.
So this one,
Metropolitan
this is
Health.
your idea, right? You found this.
No? Yeah, I guess. Yeah. Metropolitan Health Networks. Ticker symbol is MDF. It's a $9 stock. Look at that chart.
I know, that's what I don't like about it.
2009, it was up 24%. 2010, it was up 124%. 2011, 67%, and it's up 17% so far this year.
Yeah,
and
kind of a good period for them.
Sales have gone 3.6 million, 5.6 million, 8 million. Boom. EBITDA margins are holding steady at 11%. So, you know what they say in the real estate business? You know what they say?
I mean, I sometimes know, but...
Location.
Yeah.
Location.
Yeah, no, I didn't actually know that.
Yeah, that's what
I didn't
they
know
say.
what you were going to say.
No, that's what they say and this is what they say when you're looking at healthcare companies like this. Location. They provide healthcare to Medicaid customers, older patients
who don't want to go a long way.
And they're located in Florida.
on every corner.
One of my semi-home state.
Semi-home stay?
Semi-home state.
Oh, yeah.
Hyphenated.
You like the tax rate?
So, gotta love the location. Basically providing Medicare services on an aggregated basis to old people in Florida. Gotta love that. That's a trend that we like. Stock's been a killer stock. Sales look good. EBITDA margins, no concern there. Tell me what worries you.
Well, I do think you have a long, term trend in healthcare. Obviously, people are. We're a rich enough society to start putting a lot of money into healthcare, and it's not all because stuff's expensive. It's because you want to spend your money on that. When you're 70, you'd rather spend a little money on healthcare than, for example, new shoes. I'm just saying, they're choices people make, and sometimes people get carried away. Oh my God, such a big piece of GDP is healthcare. Well, yeah, because if everyone was 20, there'd be a big share of GDP on resort hotels or whatever or something. But here it's healthcare, and I think that trend is going to continue. The fear is, of course, what do these guys get paid? But I did a study on this a number of years ago. If the government or some entity, I guess I would hope it was the government instead of an invading foreign power, if the government forces prices down, then what? All these companies are going to lose money? Well, maybe for a little while, but the demand for healthcare is going to still be there. So the ones with fewer costs, more economies of scale, etc., are going to win. And I'm not advocating that because I like the free market. But if there's winners and losers chosen, they're going to choose the ones that are the biggest and that can cover the most patients. And so I think that in Florida, these guys have a pretty good foothold, whatever happens. And if prices are forced down and their profits are forced down, I think they quickly adapt to that somehow, and they cut costs, or they don't give the same service, or maybe free parking is over, and you have to pay.
They've clearly figured out they want the economies of scale. Look at 2011.
Right.
Look at what happened with the debt. Went from basically this company's never carried any debt, and all of a sudden they were up $300 million in debt, and sales are up huge. And so clearly, I think, what do you think? They bought something, which suggests that they're probably in the process of aggregating in that field.
Well, that's exactly what's going on in that industry.
You want to be that person if you're going to survive.
There's a roll-up going on in this area because you need to get better economies of scale. And
so the question is there more juice left in this, or is it played out?
Well,
it's an interesting
you
one
got
to
look at the valuation. I'd say if we bought this today, Mo, if you called that guy that you read about that did the deal in Facebook, and you got some of his buddies. I mean, the market cap on this thing, the enterprise value is $600 million. So, that's how much a group could pay, $650 million. And if you did that, you would have the enterprise value to EBITDA is 8.6. So I'm going to take the inverse of that on my HP12C. And that's a plug because I'm trying to get this thing into the Smithsonian.
Yeah.
So that's why I mention it. If they hear it, they might want to do it. So that's an 11.6% cash-on-cash return. I mean, what are you getting at the bank or in a bond? There's a lot of 20-year bonds that are maturing where when you bought them back in whenever that was, it's 20 years ago, 1982 or 1992.
Yeah.
I mean, the yields back then were, 8%? 9%? I mean, you're going from 8%. Let's say you saved your money, or your parents, you were good savers, you were good people. You saved up $1 million because you knew, and it was Millionaire Next Door. You save $10,000 a year for 50 years, and it turns into $1 million. And now you need a 6% return, which would be $60,000. That's how much you need to live. And all of a sudden, because our economy is, funded with debt that is causing our currency to be worth less, those savers are getting 1%. And now they're getting, on their million, they're getting 10,000. They can't live. Now they're into principal. And so it's really a problem, ladies and gentlemen. And one way around it is to buy companies that trade at 8.6 times EBITDA get your friends, get a group, and buy these things, and you'll get an 11% return instead of 1. That's what I'm saying, Mo. And so I like this for that reason. And if it grows, it's just gravy, because the 11% is if earnings don't grow. Okay, so next up.
Controversial.
Yeah, it's very controversial. And this came on the same screen, this enterprise value to sales screen. It's a little stock called Career Education Corp, CECO. And it's very controversial. It's gone from, let's see here, prices. Well, I can't, they're not telling me, but the stock was around $40 a couple years ago. Now it's at $7, and it's in this for-profit education area that the government has really come down on because, of course, kids borrow money that's government guaranteed for college, and then if they don't pay it back, the taxpayer's on the hook. And these for-profit institutions, it all came out in Congress over the last couple of years, they have a tremendously bad record of their students paying off these loans, and the government, I think rightly so, is going, hey, we're loaning you this money, but you're not getting an education that gives you a job that allows you to pay back the loan. And so they're looking right at these schools and their recruiting techniques and all that.
Just to clarify that, though, really right now the media is going after this whole industry. The media is saying these kids are taking out student loans, they're paying your for-profit universities, and you're not giving them an education. They're going out into the real world. They can't get a job. They default on the loans. And so, in effect, it's a transfer of funds from the government to investors.
Yeah.
With the kids being collateral damage. That's what the...
Or to the management of the schools that pay themselves pretty well.
That's what the media right now is saying. But so far, the government really hasn't said one way or another which way they're going to go on this. But you're right.
Well, they haven't said how they're going to go.
But boy, it is a tough thing to litigate against because you've got to start... You open up a big can of worms out. If you're going to go after somebody that you think is an educator but incompetent, then you're going to shut them down.
Yeah.
Where do you draw the line? So it could be tougher for the government.
Well, the other problem is the public institutions that Big Ten or Ivy League or what have you. I mean, those graduates are having some problems right now too, and they don't have the capacity to educate all the people that want education. And if you've looked at some of these charts, the only way you can keep up the percentages of the population that get college degrees as you grow the population at the rates we're going and the rate of new college growth and price of college.
Right.
You've got to go into these private institutions or for-profit because they have the capacity, and while their tuition isn't free, it's sometimes cheaper than the big public and private universities. So it's a big area.
Now the one thing that I wonder about, and you saw the big fall off in the stock. Some of that could be big picture stuff, but take a look at this, and I can only speculate here. 2012. Look at what happened with the EBITDA margins. It's been 15, 18, 17, and all of a sudden last year it was
6. Yeah.
Right.
Yeah.
So I don't know. Is that an anomaly?
We in the shop here we don't own this one. We own UTI, which trains people to be mechanics, and it's its valuation has been under pressure as well. I'm sure we've done that on the show at some point, but it's not as cheap as this one.
Right.
But what the trend has been over the last couple years is that they've had enrollment declines. In part, all this negative publicity, it affects enrollments because prospective students are reading that the school I was going to go to might be cheating me. So, I mean, that puts a little pressure. The job market's been really strong.
I don't think there's many students in those universities that actually read. I think there are some that are there for learning to read in some of them.
Well,
but not all of them actually read.
Yeah, that may be, but their parents,
might read.
They're asked to co-sign the loans.
The word would get to them.
The word is getting out because the people that are loaning the money are asking the questions when they're not getting paid back. That's really the catalyst here, is that the check was not in the mail. And these guys are going, wait a minute. So it wasn't, there's a lot of esoteric stuff you could talk about, for-profit, private education, etc. But what was happening was there was a rapidly growing percentage of the lenders that simply were not getting paid back. And the default rates on these types of schools were much higher than the default rates at your traditional public and private, universities. And so the Congress was looking at. Now, having said all that,
you don't want to catch a falling knife.
Yeah, you don't want to. But the stock has gone from 40 to 7. So that's down, I don't want to do all the math for everyone, but a frickin' lot. Yeah. And so, sales have gone from $2.1 billion in December, for the fiscal year 2010. In this year, they're estimated, and this is, I guess, we're looking at a compilation of the 12 analysts that cover this. Their average estimate for this year is $1.5 billion. So
you're seeing two things which might worry investors. You're seeing a decline in, say, an actual decline in sales, and you're seeing an acceleration in that decline. And so you sort of have to wonder, maybe the bad publicity is affecting them, and where does that stop? Do you just see sales continue to erode? Is that what people are afraid of? So I'd want to know a little bit about that trend or that concept before I stepped up to the plate.
Well, one thing we learned in looking at this was that it's a natural cycle that when you have a big uptake in jobs, so as we've talked about on the show, job growth the past couple years, it's been tremendous actually off the low, and this is very normal when people have the opportunity to get a job, then they have less, obviously, likelihood to become a student. So you always will see in the big upswing in recoveries, you see a decline,
right. That's
but
true.
It seems to be exacerbated a little bit by the fact that the government, the Congress, is going right after the recruiters saying, you are recruiting too many students because, you're just trying to get them to borrow money, and, some of that goes to the school. Obviously, tuition goes into salaries, and then they start questioning whether the guy in charge of promotion is really, should loan money go to a guy at a public company that's getting paid to promote the company? There's these issues that only governments can get into, where, hey, taxpayer money is helping you have an ad. Northwestern, university doesn't have ads or what have you. So, but they do. So, it's a whole gray area. The reason we're talking about this, ladies and gentlemen, is not to dissuade you from looking at it, because we could have passed on it. Obviously, it looks interesting from a valuation.
And look, what other public vehicle can you invest in where you get a piece of the International Academy of Dog Walking? I mean,
do they own that?
They own it.
That's amazing.
And they're franchising. They're opening 3 new centers out in Des Moines, Iowa. Shout out to you. You're about to get one, International Academy of Dog Walking. And, I think tuition is $45,000 a year. In 3 years, you get your dog walking certificate.
Oh, I'm not really seeing that on the page here.
No?
No. Was that
no,
what version? Okay, that was an M&A idea. Yeah, no, you're talking to those guys. No, I think this one is controversial, because it's quite possible the government could say, we're not loaning money to schools, students that have less than a such and such, default rate,
or
and graduation rate, or
right.
employed rate, or something like that. So you don't know. But what I'm attracted to is they're trading at 0.3 times revenue. That's pretty cheap. They're trading at 0.1 on an enterprise value to sales basis, 0.4 times trailing EBITDA. So, I mean, that's to say, if they maintain this EBITDA, your cash-on-cash return is 250%. So if things don't get worse. And that would mean to get worse, they would have to keep going down. But I'm going to argue that the demographics of post-high school population needing higher education, not being able to afford the traditional costs of traditional four-year public education that we all had a chance to enjoy. The cost of tuition alone is keeping families away, but then you also have the problem of just the sheer capacity. And so we're not going to leave these people uneducated. They're going somewhere, and there is not another path other than there's other countries and their colleges. I'm not sure that's going to be happening. So this is really, it's a gateway to higher education, and while it may not smell good right now, they're going to have to clean it up versus shutting it down. So I would get involved in this. I don't know if you buy it today, but these things have been so beat up, and you can look to their old sales values as some kind of measure of capacity. And so right now, there's a lot of excess capacity in their ability to teach kids, and they're under some scrutiny, but I'm going to guess they're going to fix the problems. They're going to have tighter, criteria coming in, and this could be a hell of an opportunity, Mo.
Well, here's what I would do just from a mechanical standpoint. If anyone out there is interested in really taking a look at the company, there are 12 analysts that follow this.
Yeah.
And there's some historical background there. This industry did a ton of initial public offerings, and they were all done by not bulge bracket firms. And so everyone that was involved in the syndicate began following the stock. So this is probably one of those companies that came public during that big boom in the mid-2000s. And so they have a lot of coverage. Obviously, these guys know what's going on. They earnings estimates in the last 6 months are all off by almost 100%. But get a couple of their research reports, see what they say. We're only flagging it as something that looks interesting. But there's 12 people who have written on this. Maybe that much visibility means the damage is baked into the stock.
I think so.
And but find out who follows it. Get some research reports. Say what they say. See what they say. I like this interesting one.
Yeah. A little contrarian, but interesting. So, okay, well, this is the exciting time of the show when we do a little thing called walking through national economic trends. Now, unfortunately, Mo, as you well know, being here with me, we haven't actually printed that or looked at it whatsoever at this point.
But what we've actually done, and you may be impressed, but it's true. We've memorized the entire document. 750 pages, 12 in some cases, 12 graphs per page. We've memorized it.
Were we supposed to do that?
This is the first show we're going to do it from memory.
I didn't get that memo, Mo.
Oh, well,
have you got your... Well, then I only have to go.
Then just print out one.
Well, just keep yourself busy.
I'll do the rest from memory.
Try to do something. All right, well, we're back. We're back with walking through national economic trends.
I thought it was paging through.
Paging through. I don't know. But, I tried to get to the printer over at the copy machine. The cleaning people are here again.
Reading the economic trends. It's hard. This thing gets printed out. Those guys, boom. You don't think some of those cleaning ladies have like $10 million and when they...
Why not just hire us and pay the fee? But no, they're reading our stuff at the copy machine, doing it at home.
They're smart.
I don't know.
Which is why we're pointing out some of these trends so listeners can do it at home.
We are now going to page through national economic trends, which you can get yourself at the Federal Reserve National Bank of St. Louis. And it's free. Okay, page... now, usually I don't find something right away, but I found something here on page 3, Mo, I wanted to talk about.
So did I.
Yeah.
Let's go.
Oh, really?
Let's go.
Wow. Well, first, in the top right, there's a little something called the Consumer Price Index, the CPI, which is trying to measure inflation, right? And they have their little basket of goods that they think is representative of what people spend, and you got your urban and your rural and, blah, blah. Well, here's what I was going to say. There's a lot of concern about inflation. And, we had a lot of spending, a lot of debt going up, et cetera. And there are a couple months here, the last few, that, 0.4 2 months ago, I could see why people were a little alarmed, because 0.4 times 12, that's 4.8. And if the long bond is a 2, that's what? You've got a negative 2.8% rate. So people paying to have their money safe kind of a thing. But I want to say the most recent month is 0.
0.
It says 0. And I don't know why. I mean, obviously oil prices are down. I couldn't tell you what, 15% off the peak. If it's 20% of your spending, 15% times 20% is 3. I mean, it could be that. But who knows why? But smart people know why. But it's 0. So I thought that was worth pointing out. Inflation canceled for last month.
Yep.
So.
Well, Professor, let me ask you a question, because unlike myself, I have a humble MBA.
Yeah. What do I have? That's what I have.
I thought you had a master's in finance.
Well, I have an MS.
Yeah.
Well, okay. You don't have that? And they're letting you do what you do?
No, I don't.
Oh, you didn't put that on there?
No.
Okay.
So, Professor.
Yeah.
Here's a question for you. Interest rates are 2%.
Yeah.
Do you remember the old Graham and Dodd formula, whatever the risk-free rate was, which was a government bond, plus some equity risk premium?
Yeah.
Those two added together.
Right.
Was sort of what you should be looking for in a stock.
That's right. Yeah.
What is that number? Because looking at some stocks with a dividend yield of 7%, and I'm thinking they're going to be no-brainers if this risk-free rate. So what does that mean?
Well, I think what it means is that certainly on those metrics, stocks are very attractive. If you take the risk-free rate,
which should be,
I mean, remember, people don't always know for sure what the risk-free rate is, but they take the U.S. government rate as the risk-free rate. It's always been viewed as risk-free. But, of course, now you had a Congress that was, in effect, threatening to default, so I'm not sure even the U.S. government rate is the risk-free rate anymore. There may be no real, actual risk-free rate. But let's say the Treasury, the near-term Treasury, is the closest we get to it. And we know that because other nations are happy to spend all their money here for us to fritter away, and they feel it's perfectly safe. And that's measured by the yield, which is basically, what's that?
3%.
The 10-year Treasury is 2, and the 3-month is about as close to 0 as ink lets you get on a page. And so, but we know inflation is, it was 0 last month, but, these things are priced. We look here, the average inflation rate the last couple years, if I just eyeball it here, it's roughly 0.2 per month times 12, 2.5%. But this whole period, the 3-month Treasury has been under 0.25%, which means people are willing to give up principal for perceived safety, which, in my career has never happened before. If you take the traditional formula you were just talking about, so risk-free rate, 0, let's say.
Right. Equity
plus
risk premium.
The equity risk premium. Well, traditionally, the equity risk premium in the stock market long-term return is 10. And the risk-free rate, as measured by a government sort of bond, might have traditionally been, 5 or 6. So, and these are estimates because you don't actually know in advance what the risk-free rate is. It's
but you're
after
implying
the fact.
about a 4%.
So it's 4 to 5, I think, and that's on the market, a diversified market. On any individual stock, it goes up from there. So if 10% is the rate you demand on a portfolio of stocks, it might be 15% you demand on an individual riskier stock, or 12 or 13. Here in the shop, we don't buy a stock unless we think it can deliver a 20% annual return. And of course, in this environment, you're happy with 10, so that leaves a lot of room for mistakes and things like that. But basically, what that old formula is saying is that if we think that stocks are way riskier than is warranted, by the traditional metric, because it would be about It would be a 5% return, which would be a 20 multiple, but pre-tax. these are pre-tax numbers, so that'd be in the mid-30s after tax, and the average, I think the multiple on the S&P 500 is 16. So, and that's the argument for the wild undervaluation of securities or the wild underestimation of the risk in equities.
Yeah.
I mean, if the earth blows up, only the bonds and the REITs are going to have value, right? No, of course not. But I mean, that's how the market's priced. Exactly. That was comedy, but it was bad comedy. I mean, my professor had the best advice for tough times. I thought there was, the secret formula for the right investment portfolio. I said to him, so Professor, what would be the best portfolio for really tough times? And he just looked at me and said, really tough times? I said, yeah, really tough. He looked at me and he just said, big dogs and guns. I said, ooh, maybe not that tough. But, I think that there's some people that are, receiving negative real rates on investments because there are those kinds of fears. And if the chaos in the world gets better, and I think, or less chaos, and the volatility gets less, I think a lot of these things will get better. Bond yields are going to drift up as the economy grows, and I think we're just in an interesting period here where equities are pretty freaking cheap.
Well, here's let me just skip ahead of you for one chart because it ties into this. Look at page 13.
13, okay.
And that's the consumer sentiment.
Oh, yeah.
It's the applause meter for the economy.
I drew a line there, but you drew like 4 lines.
1, 2, yeah,
wow.
4 lines,
okay.
Yeah. So here's what's interesting. You start this index, this consumer sentiment. How good do you feel about the economy? You started at 100 back in 2006, and it went all the way down to 55 during the financial crisis.
Yeah.
It had, 2008. It started to recover back around 75, and boom, it got hit with another crisis, which was our next banking crisis. And I think the market's worried that we might, in the next 2 years, experience a European crisis. So the third slam to consumer sentiment, consumer shutdown, it's a consumer-based economy. I think that's what people are steeling themselves for. Yeah. Are we going to see a crisis in Europe? And if we do, boom, our confidence gets hit, spending gets hit, the economy gets hit.
I think you're right about that, Bo. Yeah. Okay, well, let's see here.
So now track backwards, because you were looking at one.
Well, I just wanted, I said this on past shows. Bottom of page 3, the unemployment rate just continues to go down, and it's going down at a pretty rapid pace. So
now, the suicide rate has been going up. Do you think that accounts for the people that are now out of the job market, which could be fueling that?
I don't know on that one, Mo. Let me hold that for...
Was a headline today.
Really?
Yeah, Wall Street
I didn't see that. So paging along here, I did have something else. Let's see. I had a lot of different things. But one thing to point out was, and this ties in with that negative sentiment in 2011, there's a thing, real change in private inventory. So basically, it's bottom of page 5. This is the money that business owners are willing to invest in goods and put them on the shelf or invest in materials and start working on them to sell to customers. So it is a sign of some type of optimism about the near term. And in the middle of 2011, that number, after the prior at least year and a half being pretty positive, turned to 0. And I think that's going to cause people to take pause because all the order books start to dry up. But then in the fourth quarter of 2011 and the first quarter of 2012, we are running at a nice clip. The first quarter of 2012, $75 billion, according to this document, in 2005 dollars. So you got to add in the inflation since then. It's 6 years of 3%. So, maybe it's really 90 billion went into private inventories. And I think that's a pretty good sign of the strength and optimism that could be coming. The other thing I wanted to point out was that for all the concern about GDP, there's a chart here called nominal gross domestic product. And the interesting thing about nominal gross domestic product, ladies and gentlemen, is that it's a real number. When people estimate real gross domestic product, they are estimating inflation, and they're using generally a basket of goods to do that. So they're making an estimate of inflation. And there's lots of studies that show that they don't always estimate it just right. So the real GDP numbers that you see, which, usually run, 2, 3%, 4%, right now lower than that, is an estimate after they subtract out their estimate of inflation. Nominal gross domestic product, the thing I like about it is that it's just adding up the value of everything. And yeah, some of it inflated, but that's the number. And when I look at it, it's remarkably stable. So this goes back to just the first part of 2010. So it was, maybe 5.5% then, and then 5.5%, then 4, then 4, then 3, then 4, then 4, then 4, then 4.
Yeah.
So I thought, I'm not an economist, but that looks like we're in a pretty stable period in terms of the actual numbers before you have a bunch of economists who don't agree trying to make adjustments to the real numbers. The other thing I wanted to mention on this page, page 5, is the remarkable stability in the inventory to sales ratio. You see that over the last 3 years? This is corporate America. The ratio of the total inventory to the total sales has been between 1.31. I mean, this is the only graph in the book that's in double decimals. It's 1.31 on the high, 1.26 on the low. So let me just do the math on that. 0.05. That is a less than 4% move over a 3-year period in total inventories to sales. And what I like about that is when you see people investing in inventories at such a rapid pace, it means that sales probably are going to follow. So
now, just a quick footnote on that. We've been contacted by the farmers lobby, so we want to give a shout out.
Are they
to
not
them.
getting enough time here?
Well, here's their gripe, and I understand this. Look at this on page 5. It's the aggregate private non-farm hours, and then when you look at, it's always non-farm labor statistics, non-farm work hours, non-farm. Well, where are the farmers here?
Yeah.
They're not. They're
like, hey, we're out here too.
Right. So we're shout out.
Hey, farmers.
To the St. To we're with you, and to the St. Louis board. Listen, let's start adding farm hours. Let's start adding, farm salaries. New subgroup.
Yeah, they might have used to had that back in the days when there were more farmers, but that's a good idea. Good idea. I think, Mo, we've managed to really make this the longest show in the history of the Value Guys. So I think we better. You have something good going on there? No.
No. We did that. No, we're done.
Okay. Well, why don't we just call it an end? We've really used up a lot of time. I'm getting sleepy. I want to just thank all the listeners for listening in this week. For what we hope was a couple of good ideas, and what else? Not much else. Really.
Thank you, all of our sponsors, Goldman Sachs, who without you, we wouldn't be doing this.
No, we wouldn't.
Well, not as profitably.
No, that's true.
So,
and I want to also say a shout out to the Federal Reserve of St. Louis. We use their materials here on the show. We might as well be appreciative and show them a shout out. And I also want to say hello to Canada, because, hey, it's our friendly neighbor to the north, right?
And the Soviet Union, where we're now being carried actually on their one
ComSat
radio station.
Yeah. So, all right. Well, thanks for listening, everybody. Catch us on iTunes and other places at www.thevalueguys.com and see photos, past shows, and diaries. I don't know what else. Have you put something up there, Mo?
Not yet. Not my baby photo. I'm waiting for that to come back from the Photoshop people.
All right. Well, have a good day, everybody. Thanks very much.
Bye.